He's the Secretary General of the OECD, the influential think tank that advises governments and makes economic predictions. Angel Gurria with us this morning from Paris. Good morning, Angel. Good morning. You say the European Central Bank needs to act. We know how you feel, but you're inside these summits and these meetings. How realistic is that?
Well, that will have to happen. It's not a question of being realistic or not. It's a question of when. You cannot fight a war if you keep your major weapons in the closet. You have a much better chance if you bring out your overwhelming force, and the Europeans have it. If you combine the European Central Bank, if you combine the EFSF, maybe what a contribution that the IMF could make, all together and with a very clear signal that you're willing to use the weaponry, short term and medium term. Going for the fiscal discipline is a very, very good and desirable outcome. That was well chosen, well identified. But now we need to deal with a house on fire, and that's Greece. The deal with the private sector is not happening, at least not yet. And then the firewall to avoid contagion. And, of course, the question of how do you then inject elements of growth going forward, and the capitalization of the banks. Every day we have more news about banks with bad surprises. That has to be put to rest.
All right, stop the fire, you say. Is it all just European politics here? Is that what makes this so contentious and why the European Central Bank cannot act?
Well, it's not just politics, it's also markets, and it's also the fact that you have countries that go constitutional with balanced budget amendments. They deal with their banking system. They deal with their retirement and pension plans. They deal with their labor market. And still, the markets are focusing on them. Clearly, what the countries are saying is, so what else can we do? And are we going to continue paying 6, 7, or 8% for money, which is more than double what you're paying today, simply because the market maybe is not taking notice of what we're doing? And that is not going to happen for too long before you have a very strong reaction.
Angel, you and I spoke at least a year ago. You said the euro is going to survive and thrive. But the OECD just put out its recent economic report saying growing doubts about the survival of the eurozone and the euro have caused global growth to stall. So this is no longer off the table, and the risks are rising in your view.
I think we're going to have a very slow growth. The last quarter of 2011 it may be in the negative, including the first quarter of 2012. That's a possibility. We said the Eurozone was going to grow at 0.2 or 0.3% next year, which means some of the countries are going to be in the red. So we see a 2012 which is going to be very protracted, very difficult. But we also see that if countries get their act together and they overcome this problem that we're seeing now by focusing on structural measures and by focusing on going social, taking care of the most vulnerable, we can still see a period where at the end of 2012, beginning of 2013, we can see a brisker growth. But that has to be a concerted effort. The G20 has to get together again in not to discuss items in the agenda, but to fight this particular issue, and it needs everybody's support and everybody's contribution. As I said before, the IMF is part of the solution, and of course that means non-European members have to be on board.
Angel, Europe is the #1 threat right now to the global economy. It's why you say the IMF, the G20 need to step it up. Also, you want the European Central Bank to step it up. None of this is happening right now. So what is the big risk here?
Well, it's very simple. Every day that passes, the situation gets worse, the losses get greater, and the confidence is more difficult to recover. And this is a problem of confidence as much as anything else. Here, you're talking about the governance, you're talking about the institutions, And you're talking about the political rigidities when 17 countries have to take decisions, some of them legislative decisions, some of them political decisions, some of them very tough administrative decisions with shaky coalitions, etc. The process is difficult, but they have decided to go for that very, very important discipline on the fiscal side, medium and long term. They have created a de facto fiscal union. That is very good. The question is, what do you do with the markets today? How do you reassure the markets today? How do you show awesome firepower? How do you show the muscle and then tell them, and I'm willing to use it? You can't go to a fight with one arm, tied behind your back.
Angel, it's Erik here. If in fact you are correct, they do have a de facto fiscal union, why on earth do we need the IMF to step in? How do you persuade, how does Angela Merkel, how does Christine Lagarde persuade the Americans, the Brazilians, the Chinese that they need to step up with cash when, in everyone's analysis, Europe has enough money? It's just a question of which Europeans have the money.
Yeah, this is a question of size, and size matters in this particular issue because it has to be comparable to the size of the problem. The size of the problem is the maturities coming due in countries like Spain, like Italy, and some others in the next, let's say, 12, 15, 18 months. That's in the hundreds of billions. And the question is, can you do that with 250 billion that may be left for the so-called EFSF? Can you do that credibly, and while at the same time you're trying to support all the European banks, which today are running out of funding? And at the same time, why do you bring in the IMF and why do you bring in the others from outside? Well, but the others want to help, but they don't want to do it directly. Countries are very bad to impose conditionality on other countries. So it's okay that they do it through the IMF. The Europeans are very bad to impose conditionality on themselves. So it's good that the IMF comes and does that job. But they do need to reinforce the armory. And most importantly, they need to activate the European Central Bank. The European Central Bank has the capacity to do the job, has the capacity to keep those yields low, and therefore to reward, in a sense, those countries that are doing the right things and biting the bullet today and that are being attacked by the markets.
Meanwhile, this is all spilling over into the global economy. How concerned are you about places like China, which is facing its own domestic tightening as well as worsening external pressures like what's happening in Europe?
What is happening in China is probably salutary, is probably sound, and that is they've come down from 11% growth that was overheating the economy to perhaps 8-9% cruising speed. I think that's okay. Now the problem is they're slowing down a bit too much, perhaps for their own taste. So they're easing the monetary policy. And China, of course, depends a lot on external demand. External demand around the world is dropping because the growth of the United States, the growth of Europe, the growth of Japan is very, very weak. And therefore, China is going to have to do more of internal domestic demand push so that their economy can continue to grow at the same speed without the support of the demand from the outside world.
Angel, how about the U.S. economy? We hear people say that it's just a matter of time before investors start to reprice the Treasury market. What happens if we see play out in Treasuries what happened in Italy, a 200 basis point increase in 10-year yields in the space of 3 months?
Listen, I think the Italian situation shows that we have today a very misaligned set of calculations and expectations after the package that hopefully will be approved today in Italy and confirmed on the 23rd of December by the Senate in Italy. I think, maybe markets will calm down some. But the U.S. is critical, not just because of the U.S. sake. The U.S. is critical for the expectations in the whole of the world. The U.S. is showing better indicators, signs of some recovery. For example, the new job figures 8.6 instead of 9%. Of course, we know that maybe because that's a lower participation, but still that is promising. You have some recovery in some of the other indicators. Now, there's still downside risks in the United States, but I think there the greatest concern is the governance of the decisions. And the fact that the political forces, and including the leadership, the president, his team, his cabinet, can actually go in the right direction, signal in the right direction, and gather enough political support behind them to go in that direction. The medium-term package to reduce the deficit and the debt. And then I liked very, very much that job package that was proposed a few weeks ago. Unfortunately, that didn't pass muster in Congress.
No, it's pretty difficult to get anything done in Washington these days. Angel, nice to see you this morning, and thank you for joining us. Secretary General of the OECD, Angel Gurria.